Wall Street tends to think that AWS is the key to Amazon's cash. AWS is important, but look at 3P seller services closely, unpack them to see the real value of Amazon. Amazon's a safe bet, buy if you can. And while the COVID growth has slowed, it is still a big, sexy beast. Welcome to the Day 2 podcast. Today's episode, who's buttering Amazon's bread, AWS or marketplace sellers? We'll unpack Amazon's April earnings call with my friend and tech investment expert, Rohit Kulkarni of ROTH MKM Capital Partners. I'm your host, Jason Boyce, founder and CEO of Avenue 7 Media and co-author of The Amazon Jungle. Just a little about Rohit before we get started. This is the first time Rohit is being introduced to our audience, so I want to give his full bio. Rohit is a managing director, senior research analyst covering internet and capital markets at ROTH MKM. He has almost 25 years of experience across technology products, investment banking, and institutional investments, both private and public. Before joining MKM Partners, Rohit led pre-IPO investment research at SharesPost. He began his equity research effort as part of a Citigroup's internet research team, ranked number 1 in the institutional investor ranking for 5 years. In addition, Rohit has held equity research analyst positions at RBC Capital Markets and Robert Baird. He's got a BS in computer science, I did not know that, Rohit, from the University of Mumbai, an MBA at this school that nobody's ever heard of called the Wharton School, and another MS in a school, I can't even pronounce it, Rohit. It's such a fancy...
Rensselaer.
Rensselaer.
It's in upstate New York.
Okay,
Yeah.
Thank you. It's so fancy, I can't even pronounce it, Rohit. Thank you for joining us today. You have been busy. Last week, I got to see you on the television on CNBC, sharing your Amazon earnings thoughts, and today we are very honored to have you as our guest. So, Rohit, thank you for being here, and how are you doing?
Jason, thank you. Thank you for the very kind intro. Thank you for hosting me on this call. It's been busy days. It's been volatile times on the market, on Wall Street. But again, whenever Jason calls, I've learned a lot from Jason about Amazon and the internal workings of the marketplace. So I'm very happy to be here on your show, Jason.
Well, the honor is mine, Rohit. Thank you so much. I appreciate your kind words. Let's start at the 30,000-foot view, Rohit. Last year, 2022, was pretty nuts for big tech investment and big tech stock prices. At a high level, what happened? What did you see? And then land the plane by telling us a little bit about what kind of changes, if any, you've seen this Q1 compared to last year.
Yeah, 22 was a year like any other. It was punctuated by a series of unfortunate events. At the beginning of 22, people were very bullish as to what we are out of the pandemic, things are going to be great. Then comes along the attack on Ukraine, and then comes along very high inflation. And right now, we are at a point where the macro and the Federal Reserve have increased rates to levels that many people who are listening to this show have not seen in their lifetimes. So we are witnessing something. We witnessed something in stock market last year that very few people who are alive, or at least in their working age, have not witnessed. More than 5.5% in interest rates. Tomorrow or day after, when Fed meets again, they'll probably raise the rates again. So that means everybody's cost of capital is going up. So that's what happened in 22. On top of that, when you zoom into e-commerce, when you zoom into what happened to Amazon, you had this tremendous overbuilding of what they did during the year of 21. During the pandemic. So they started to unwind that as Russia war happened, as inflation started to rise, as customers started to buy slightly less than what they would have otherwise planned to. And that unwind process started to hurt some of the efficiencies that Amazon thought, many e-commerce people thought. So as I said, it was a series of unfortunate events starting from February through December. You asked me at the end, Jason, what's going on at the beginning of 23? I think there is this classic phrase that everybody on Wall Street uses, cautious optimism. I think that's where we are at. We see that from a macro lens, as a 30,000-foot lens, we see the beginning of the end of rate hikes. So by that, what I mean is, if Fed hikes rates this week, probably they are going to take a pause. That's what the market is saying. Probably they are going to take a pause in the next 6 months and see what happens to the economy. If that is the case, then that's a good sign for the markets. So that is the cautious optimism. I can go into what happened in 1Q in more detail, but 22 was a year that a lot of people in Wall Street would like to forget. They will never forget. It was a once in a generation year with the war, inflation, and rate hikes, which kind of complicated the lives of many, many companies, including Amazon.
I love that phrase, a series of unfortunate events. My daughter just read the book and we watched the movie as a family recently. So my goodness, I think that you're right. That's a total understatement. And, Rohit, from the seller's perspective, when we were at Prosper Show in March, we had this very distinguished panel of big Amazon sellers and brand representatives. And it was almost like a tale of 2 years from the retail perspective. The first half of the year, everyone was expecting that demand to continue into forever. They were still having supply chain problems. So it was buy as much inventory as you could. And then all of a sudden the door slammed shut on it. And it was a whole different year through the second half of the year. Of course, there was panic, there was inflation. You're right. Gosh, I'd forgotten about the war in Ukraine. Just an awful year. And, luckily when we finished our panel at the Prosper Show, Rohit, it was happy hour. So there were free drinks provided by Prosper. So I said, let's go all drink our sorrows from 2022 away and forget that this year ever happened. So you're right. Thank you for that very good synopsis of what happened last year.
And Jason, you were at our conference earlier in March, and don't forget what happened in March. One of the biggest banks in the US, it is one of the top 10 banks in the US, Silicon Valley Bank, that shut down. So although we aren't seeing the ripple effects yet, another bank is shut down today, First Republic. So I don't want to be like a bearer of bad news or like a gloomy guy here, but again, things when it comes to macroeconomic stability, we are not there yet. We hope that we will be there in a couple of months, and that would make the lives of consumers and a lot of sellers on Amazon a lot better. But based on what we are seeing in 23 so far, it feels there is that cautious optimism is getting pushed out a little bit. 2 banks being shut down in a matter of 2 months, and those are pretty sizable things.
It's a great point. I mean, I'm old enough to remember as a kid watching television commercials, and every retailer had inflation busting. They had like these big signs with a sledgehammer, and they'd try to crack the inflation nugget in the early 80s. And so it is very unusual to see that coming back now. And one other story to add to that, Rohit, my next door neighbor, I was talking to her yesterday and she said, I just lost my job. Who do you work for? First Republic Bank. She's like, I don't think I'm going to have a job next week after seeing what's happening here. So you're right. It's like a mini bank crisis mixed in with all these other problems. So I think that there is a lot of trouble. Hopefully it's more in the rear view mirror instead of in front, looking down the highway, I hope. And I loved your phrase, cautiously optimistic. Now, we're here to talk about the Amazon earnings calls. It seemed as though investors were really holding their breath about some of the big calls this week, or I should say last week. You listened to the call,
Yes.
Andy Jassy was on the call, which doesn't always happen where the CEO joins the financial call, stealing, the CFO's thunder a little bit there. But I think it talks about, I think the reason why he was there is because there's this recognition of all the things that you were saying, and everyone wants to hear from the leader. How would you grade their quarterly earnings for Q1 from last week? And what was your take on the things that Jassy and the leadership team were saying?
In isolation, I thought Amazon and their earnings last week were, I would say, 4 out of 5 stars. They were amongst the better earnings that we have seen in the last, call it, 12 to 18 months. They were, on a fundamental standpoint, the company reported upside across the board. People didn't expect them to report upside to cloud, yet they did. And from the e-commerce standpoint, it was a lot better than what people expected them to report. So all in, the numbers were good. The guidance, which is second quarter, what they hoped to do, was better than expected. But the stock was down simply because of one single number, which is what was cloud doing during April. That's a bit of a noisy factor, but when it comes to just broadly the state of the earnings of Amazon, I thought it was a very, very good fundamental improvement, not just in revenue, but also profitability and a lot of good things that Andy Jassy was hoping to bring them across. But sadly, Wall Street is very, very fickle, and they focused on just one number, and that brought the stock down.
Well, we're going to unpack that AWS number shortly. But, one of the things, Rohit, that you and I have talked about offline is Andy Jassy's cost cutting. And by the way, thank you again for your invite to the panel at Roth's conference in beautiful Data Point, California. If you get an opportunity to go to that conference next year, you got to do it. A lot of great high-level information was presented. You can do some deep dives with some really leading companies in the overall market and see where trends are heading. So thank you for that invite, Rohit, and it was a pleasure to be there at that show. Since then we've talked, the cost cutting's got me a little nervous with Andy Jassy. And I know Wall Street likes that. They like to see an increase in profit dollars. But I'll tell you, there's one area, if we look at what makes Amazon what it is today, number one, it's their incredible loyalty and their Prime membership. They own the online customer to the tune of more than half of the online GMV, gross merchandise value of goods sold in the US. They have the ability to store, pick, pack, and deliver to your door better than anyone in the business. And then, they've also got sort of this AWS leg, if you will, this presence and technology winning strategy that supports it as well. But when Andy Jassy came out in his annual newsletter, which I read probably 3 or 4 times, the one thing that popped out of my head tracks not his optimistic view, but a negative view from what we're seeing across our 100 plus clients here at Avenue 7 Media. Number one, Jassy wants to be seen, in my opinion, as the grown-up in the room. Hey, I'm reminding you guys, Amazon in the 2001 .com crash, we made some deep cuts. We made some big changes. In the 2008 Great Recession, we did it again. In this pending recession, whether it's here or not, some believe it's here, some believe it's coming. He believes that he's getting out there and saying, we're getting ahead of this recession. We're taking the deep cuts now. We've laid off 27,000 corporate layoffs. Turns out there's even more coming in the cloud department. Okay. And in his view, we're tackling, these are his words exactly, tackling the rising cost to get a product from Amazon to a customer. And we've made several changes that we believe will meaningfully improve our fulfillment costs and speed of delivery. Okay, I'm a little bit nervous now. You're cutting your fulfillment costs while at the same time you're increasing fees on Amazon sellers. I imagine investors like to see that. But last year, he goes on to say, we started re-architecting our inventory placement strategy and leveraging our larger fulfillment center footprint to move from a national fulfillment network to a regionalized network model. We're on track to have our fastest Prime delivery speeds ever. Rohit, let me tell you what we're seeing. In the previous episode, I had one of our experts at Avenue 7 come on, Malia Kim, and she has been unpacking a whole mess of problems in FBA. For the first time since COVID, we are seeing scores of clients who have dozens, if not hundreds, of pending FBA orders that are days, weeks, and sometimes even a month long. Haven't seen anything like that, not since COVID, right? And then there's also another program called the In-Stock Head Start program. I don't want to unpack that too much, but this program has really run amok. And we're starting to see examples of programs that were launched with good intent, with good value proposition, and then all of a sudden, they're broken. They're not working. So what we're seeing, Rohit, is we're seeing some very troubling signs. Now, hopefully, this is a new program. Amazon is aware of these problems, no doubt because we're being loud and obnoxious with them about these problems. And I know other sellers are experiencing them as well. But is it possible that red pen got a little too thick lined and he's cut this stuff not to the bone, but into the marrow?
Oh my goodness. If that's true, then we and Amazon and a lot of investors at Amazon are in a whole lot of trouble. The way I see it is they are taking this cost cutting aggressively, and they should, in my opinion, from an investor's perspective. They doubled their fulfillment center footprint. They hired more people in the last kind of 3 years than what they had in the prior 8 or 9 years combined. So again, I think they are growing their base. However, the base is not growing as fast as the cost has already grown. So that's number one. But while they're cutting costs, they are trying to adjust some of the processes, some of the kind of software internally that they use to optimize delivery and whatnot. They talked about this with investors at length, tried to explain that. It was more of a, this is what we are trying to do and this is what we will improve upon. And the end result is going to be very fast Prime delivery. That's the promise that they have. By the end of this year, they'll have the fastest Prime delivery that they have had in the history of Amazon. And as they are going from a hub and spoke model to regional fulfillment center model, I believe there is going to be some complications and probably more headaches to sellers who are used to putting their product in Amazon in one single central fulfillment center or maybe a couple of clusters of them. Now Amazon is trying to distribute that into more regional fulfillment centers. That creates probably some issues with inventory and probably some issues with downstream logistics. On the earnings call, what I'll tell you is they said that they are early and they like the early signs of progress. So perhaps you may have the answer in the next few weeks, but perhaps what they're hoping to solve is before they get to back to school, before they get to the real next big holiday next big shopping event, they hope to have ironed out all these things. Maybe we should talk in a couple of months and see where they are at. But that's the interpretation from Wall Street that I can give you is things started off to a good start. And let's hope they end well by the time we really want them to end well.
That's my hope as well, Rohit. I hope that they're seeing these before we are, and they're making the tweaks to this new, more efficient system. Of course, I panic a little bit because the last thing Amazon wants to do is break that Prime promise. And we're seeing that a lot. But I thank you for your perspective from the investment community. If they can do things from their marketplace revenue that improves efficiency, lowers costs, increases margin, that's a win-win as far as Wall Street is concerned, right, Rohit?
Yeah, absolutely. As again, at the end of the day, what investors want is oversimplifying, but better and higher profitability. Nobody is worried that Amazon may eventually run out of ways to increase their revenues. Amazon, we know, is largest in e-commerce, one of the largest in the cloud, advertising, and they have so many pillars of revenues. But with the investments they did during the COVID times, people are getting more and more worried around how much profit can this company generate. And now there's a very kind of fast race that the management team is on to kind of prove to the investor community that yes, we can generate profits, and this is how we are going to show you how we will do it. So there we are at, as in it remains to be seen. And in Wall Street, we call this as a show me story. Show me that you can do it. And rarely does it happen that a $1 trillion company becomes a show me story. A $1 trillion company has already shown you what they can do. But right now, that's where Amazon is. That's why there is so much controversy around it.
It's a great point. Andy Jassy must be sitting there thinking, what the hell do I have to do? It's like a $1 trillion valuation already, right? It's a good point. It's a good point. Rohit, I want to unpack some of the revenue numbers. They're just staggering. I mean, each one of these line items would be just amazing if it was a standalone company. Number one, Amazon likes to break these revenue streams down. Online store, $51 billion. Not in a year, folks, in a quarter. Online store. So that's, Rohit, I just want to check in with you and see if I understand these correctly. That's 1P revenue, right? That's a Amazon product being shipped and sold by Amazon, as you see in the buy box. Is that correct?
Exactly. It's first party sold by Amazon. That's $50 billion worth of products. It was up about 3% year on year on a constant currency. Constant currency is essentially adjusting for US dollar fluctuations on a year on year basis. So that's what investors look at. It's accelerating, but not that much. It was 2% in 4Q. Now it is 3%. It's forward progress. And that's what investors want. And there is expectation that it would continue to grow faster and faster. Even at this scale, that's a very good sign.
Excellent. Excellent. Physical store revenue, $4.9 billion. I think, Rohit, this is Whole Foods and fresh stores. Did they close some stores as well, like 4Stars and the bookstores as well? Did they make that announcement?
They have, again, fairly small from an investor's perspective. It's mostly Whole Foods. With higher inflation, such places do better. So they are growing faster than online stores even, 7% versus first-party online commerce at 3%. So again, positive progress. It's less important from investors' perspective.
The next line item, third-party seller services. Like in my mind, Amazon is a service business first, right? They're no longer really a retailer in spite of $51 billion in gross revenue. Third-party seller, this is the line item that in a minute I want to unpack a little bit more. Really big growth here, 18%, $30 billion line item. And is this FBA fees and referral fees? Is there anything else that they tuck into here? Or is that the lion's share of it?
They used to tuck in some of the advertising until they started to break it out. And now it's completely based on the three kind of fees that sellers pay them. The listings fee and various different other fees. So
love it. We're gonna unpack this one a little bit more because I wanna challenge a premise that comes not from you, Rohit, but from sort of the Wall Street folks, that the ones that didn't give a better stock price increase to Amazon after this. Pretty good. 4 out of 5 stars is good. I think they should have seen a higher bump in their stock than what they received.
And this is one of the fastest growing segments of Amazon.
Yep.
You have the third-party seller services. Then after that, you have advertising. These are the 2 fastest growing segments, and both are going towards the same set of customers, which are the sellers.
Yeah, absolutely. And subscription, about $10 billion in there, up 15%. That's Prime and Audible subscription fees. I mean, geez, that's impressive. That is a great annual business in one quarter. Just this little line item that nobody even really talks about much, but good grief, that's impressive.
And they have shown pricing leverage. That's the best thing that investors want to see. By that, what I mean is you increase prices, but consumers continue to pay. They increased prices last year or started to grandfather people into higher pricing. I'm sure you saw that, Jason, to slowly bringing the pricing up on Prime. And yet we are there and we continue to use it. So that's what investors want, and that's what Amazon is kind of quote unquote getting away with it. I
mean, you give away everything in the kitchen sink, and people think, I'll take my $20 increase a year. I'm fine with it, or if I $10 increase.
Yep.
That's pricing power. That's awesome, right? So advertising is a big one. $9.5 billion. It seemingly came out of nowhere. Like you said, they broke this out as a separate line item when it got to be, almost a third of what the seller fees are. There's probably some vendor central advertising spend in here. I know we have 1P clients where we manage their advertising, but I would guess the lion's share is this is clicks through sponsored ads program. That's 21% growth in a quarter for advertising. Rohit, how does that compare to Google and Meta revenue growth in the quarter?
Oh my goodness. So this company is, as an Amazon Ads, is taking market share away from, you name it. So it is the 3rd largest advertising company in the world right now, based on revenues. They are at a $55 billion annual run rate in revenues. Next leg up, and that's growing 20%. Whereas you have next is Facebook, $100 billion in revenues, growing 2 to 3% year on year. And then you have Google, about $200 billion in revenue and growing maybe 5 to 7%. So, but look at the way this Amazon Ads is growing in a way that's taking away market share from both Facebook and Google, creating new market and kind of hopefully providing value to its customers. Otherwise, it wouldn't have been here. So it's one of the best new businesses created on Amazon in the last 5 to 7 years, and I think they're unstoppable, the way they're layering on both marketplace and advertising, unlike Facebook and Google, which have owned about 70% of global advertising, and now comes along Amazon that is taking a very, very solid place. And actually, I'm pretty sure both Amazon and both Facebook and Google are getting scared with the way the Amazon is kind of grabbing the seat at the table.
Well, and if you look at this, when we pitch DSP, demand side platform advertising, to our clients, we're like, name one other company that has as good of as first party data as Amazon does. Apple really threw Facebook for a loop there. And, Amazon, the folks internal to Amazon, they like to say this, Facebook knows what you like, Google knows what you search, but Amazon knows what you buy. That first party data is gold. And the big news from my perspective on the advertising front is that for the first time towards the end of last year, beginning of this year, now you can take that DSP advertising dollars and point it to your .com. That was never the case. And many that have been in the Amazon advertising space for a long time, Rohit, said that'll never happen. Well, guess what? Andy Jassy said we're going to do it. I mean, they've got to be looking at this and looking at that Facebook market share as a bullseye, as a target for them to reach. What do you think is the ceiling here for this ad business in an annual run rate moving forward? Is there a ceiling?
There is, at least in the foreseeable future, they continue to take market share away from Facebook, and they've already taken a lot of market share away from Google. Now Facebook's turn. I think that's next 3 years probably. They take away a lot of market share, in my opinion. And with this entire concept of non-Amazon owned and operated properties, and you can target Prime customers on them using DSP, using Buy with Prime, I think that unpacks an opportunity that we haven't seen them scratch the surface yet. Next couple of years, I'm sure, Jason, we'll be talking about this at length, that why did Amazon go from $50 billion to $70 billion on advertising? And the most of that bulk that came up, maybe 10 billion of that is because of DSP and because of all these things outside of Amazon that they're doing. And where did that $10 billion come from? I think some of the larger platforms had to pay that price. So I think that's the writing is on the wall and it's unstoppable. That's a freight train coming towards the larger players. And the first party data that you just said, I'm going to borrow that phrase.
Please,
at some point.
I stole it from Amazon. You're welcome to steal it from me. What's amazing to me is that, Wall Street, at least in this quarterly earnings call, to look at the glass half empty, right? And maybe it's this animal spirits being what they are with the macro economy, as the economists like to talk about. But, they're focused on AWS, which, by the way, did $21 billion in the quarter, but oh boy, it only grew 16%. They didn't focus on the glass that's half full, which is advertising is about to become a juggernaut for Amazon. Can you help me understand this AWS thing? Why is Wall Street so obsessed with AWS right now?
The way Amazon reports its profitability is, we went through these 5 lines of business, first party, third party, advertising, Whole Foods, and so on and so forth. But the way Amazon tells us profitability is through 3 segments: North America, International, and AWS. So North America has a lot of moving parts, and they just kind of lump into there even the fact that they're going to kind of launch rockets to the moon. They're going to create their own internet service. Like everything that they're going to be investing in gets thrown into North America margins. And investors look at this and say, oh my goodness, e-commerce in North America is losing money. E-commerce in Europe and Japan is also losing money. And what is making money? AWS is making money. And when AWS starts to grow at a slightly slower rate, you can draw a straight line out in Excel sheets and say, oh my goodness, 2 years from now, Amazon may not be making money because the only segment that was clearly profitable is now no longer going to be profitable. But they tend to forget the point that you made at the beginning of this discussion is e-commerce in and of itself makes a lot of money. The only reason they are not showing it to the world is because of all the other things that they keep throwing at building the e-commerce, advertising, and various different businesses that they have. So again, that's a long-winded way of saying that's why investors overly focus on web services and the level of profitability that they have. But I think the broader thing is Amazon, if they choose to, they can show a lot of profit on e-commerce. They just don't choose to do that. Yeah. And that's why AWS is kind of the shiny object in all of Wall Street.
Well, and all these Wall Street analysts, you guys have a ton of companies to look at. So it makes it nice and clean, especially in most recent P&Ls because Amazon's making it easier for you to see the full impact of the AWS to their business. They're just not doing that on the seller services side. And we're going to try to break through some of that opacity here for a second. Wrapping up the financial numbers, $3.2 billion in net profit. That's pure cash flow to the bottom line after all those different revenue streams and all the different costs associated with it. Let me tell you how I see this third-party seller service business, and tell me please jump in and tell me where I'm wrong. Let's say that 30%, I should say 40% of the $30 billion in seller fees goes to FBA. Those are FBA fees, right? So that leaves about $18 billion of that $30 billion in revenue from seller referral fees. That's that commission, if you will, for every sale that happens from a third-party seller on Amazon. Amazon takes on average about 15%. If you divide that 18 billion by 15%, that's, about 120 billion. So GMV wise, my very napkin math estimate is you add that 120 billion from third-party sellers to 50 billion, that's $171 billion.
Yep.
Does that math add up for you?
I think you're very close.
Okay.
I'm going to
hand grenade close works for me.
Like all Wall Street analysts, I have somewhere close to $650 billion in $650 to $700 billion in annual sales happen on Amazon every year. So
that's great.
Your 170 times 4 is kind of in that ballpark.
The key bookend there is on a $1 trillion market. So 650 billion of $1 trillion market online in the United States. That's a very big number. That's a very big percentage. So then unpacking ad revenue a little bit. Look, the gross margins on the AWS or the operating margins, as I say, they're looking at about 24%. It costs a lot. You got to buy machines. You got to pay for power that goes up and down. You got to pay for all the technology and the service techs to keep that stuff running. But with ads, with advertising, that's got to be a 70% margin. If most of the traffic is going to owned and operated properties on Amazon.com, that's got to be a fat margin, is my guess,
Yep.
Right?
I think it has to be, in my opinion, at least 45 to 50% margin business. If AWS is 20-25% margin business, advertising is at least 50%, could be higher.
I agree with you. I think that's the floor, Rohit, because they're basically taking real estate that they already own, that's already getting traffic, and then sectioning it off and charging space for it. Now, DSP, those margins for DSP where they're paying for digital ad space off of Amazon, certainly that would be a lower margin. So maybe that's where it comes closer to your number than my number. But let's be generous here, and let's say that it's 70%. That's $6.6 billion in cash.
Yeah.
Right? And everyone is jumping up and down and going, woohoo, AWS did, $5 billion. This is the greatest thing in sliced bread. But can we talk about advertising more for a second? Holy crap.
And also, bear in mind, right now, the market, the advertising market is growing single digits. That's the most compelling thing, where this company that is growing 4, maybe 5 times faster than the market, and adding operating margins in 70%, let's take your number. So that's even more impressive than what the cloud market is growing, maybe 15 to 20%, and this AWS is growing in line with the market with slightly greater profitability. Whereas advertising, they're growing 4 times faster than the market and at much more profitable levels.
So Rohit, if we add all this up from the seller services money, profit dollars, free cash flow going down to the bottom line. Let's say, it's 5 billion on ads. Let's go closer to your number. It's 5, not the 6.6 billion. Referral fees as part of 3P seller services is at 18 billion. Now, certainly there are costs associated with that, but a lot of that technology has been built and is being used as a 1P retail platform. So, how do they allocate those costs, those technology costs required to make the marketplace work? I don't know, but that's 18 billion. And then you throw in the ads or referral fees, and then even FBA. And I'm telling you, Rohit, here's my hypothesis. If FBA is not making money, something's wrong. If FBA was not making money from sellers, that FBA fee, storage fees, late fees, all that stuff associated with it, there's no way in hell Andy Jassy offers buy with Prime to .coms. There's no way he's going to add a money loser, right? Maybe they're making 10%, maybe 5%. I mean, that's a very big dollar number that's going down that dwarfs AWS. So again, maybe I'm all wet here, Rohit, but I think that Amazon knows this. They know that marketplace business, the ad business, which is largely marketplace, is driving more cash to the bottom line than AWS, but they like this red herring that they throw out there. Not that AWS should be considered small or insignificant, but I think AWS is a small amount of cash flow compared to what the marketplace is driving. What do you think? Am I crazy?
No, not at all. As in, again, there are aspects where, for example, we don't have the information from the outside that Amazon is disclosing. That's number one. Number two, we know that Amazon, from a retail e-commerce standpoint, they have probably overinvested. So there is unwind going on right now. But also the third point I would add is kind of tilting it into the favor of third party is that there is no Microsoft or Google or any other company that can anywhere come close to what Amazon has done when it comes to building the marketplace. There is a Microsoft, there is a Google, and there's another long list of cloud vendors that are trying to play catch up to what AWS is doing. So that's the biggest risk when it comes to, okay, I am a very large media company. Should I go to Microsoft or Google, or should I go to Amazon when it comes to using their cloud services? So there are options emerging in the last 5 years. Now, I'll ask you this: when you talk to sellers, what are the options emerging for Amazon Marketplace? You'll be probably, okay, maybe you try a couple of other options. Maybe it is Walmart, maybe eBay. I don't know what people are using nowadays, but 99% of the people are still going back to Amazon. So there is a fundamental difference in what marketplace is. And I think, to your point, investors tend to forget the competitive dynamic in e-commerce versus cloud.
Well said, Rohit. And to answer your question, I mean, I think Shopify is in there, a direct-to-consumer website. But, we've done the math on this, Rohit, and we looked at the gross margin profits on an Amazon sale versus a direct-to-consumer sale. And I got to tell you, the cost of acquisition on Shopify is 4 times on average more on Shopify than it is on Amazon. And, what a lot of direct-to-consumer retailers forget to do is calculate what their fulfillment costs truly are. That's a big line item for Amazon, of course. But again, I'm convinced they're making money from third-party sellers on the FBA fees, no matter how small, whether it's a single-digit margin or low double-digit. And by the time you add up all of those costs on a DTC website, the profit margins are in some cases, in most cases, better on Amazon. So Shopify is definitely up there. And Walmart, I got to tell you, I think Walmart is the only other game in town who understands what Amazon is hiding from Wall Street, which is this marketplace business is a cash cow. I think they're finally getting it, Rohit. They're seeing those. They got that needle in the arm with that ad revenue dollars on Walmart right now, and they're not taking it out. So it's highly profitable. It's cash flow into the system, and they are reinvesting in smart ways. That being said, today, if you can get to 10% of what your revenue on Walmart compared to what you're doing on Amazon, that's a huge win. I'm hoping that grows over time. We're managing Walmart business now, so we're going to get a good snapshot into that. I see the AWS landscape, and I think this is healthy for the country. You got Microsoft coming in, you got Google coming, you got some competition going. It's driving down costs, and people are paying close attention to this. It's just not happening in the marketplace space. Amazon can continue to raise FBA fees and not do anything to cap advertising fees, not do anything to lower the marketplace fee structure, that 15%, and there ain't nowhere else to go. They're stuck, right? So that's an incredibly powerful position. To your point, that's even a better argument for why Wall Street should be getting excited about the market, right? Because there's no competition yet.
Exactly. Yeah. And again, I think that's Wall Street tends to focus on kind of the easier aspects and kind of try to focus on things that make them differentiated. So I think that's where AWS is right now. The story of retail is written, and it's the last page is how Jassy will write. And from AWS, the story still needs to be written. And that's why investors are overly focused on the various puts and takes on the cloud. Whereas, as you said, Amazon is hiding a lot of money inside retail.
I love how you put that there. Rohit, looking ahead to the next quarter, aside from paying close attention to Prime membership numbers and what's happening in FBA with these new efficiencies, what are you and do you think investors are looking at and hopeful of in the coming quarter for Amazon?
I think if there are two numbers that people will focus on is just the margins for North America e-commerce and margins for international e-commerce. From a revenue standpoint, I think investors are less worried right now because you have high inflation, so that helps a little bit on revenues as well. So the cost of a product that you're selling that Amazon recognizes as revenues is going to be higher. So the revenues are going to be okay, so long as the consumer does not weaken dramatically, and there are no clear signs of that. So that's one. So more important is what happens with the margins, and do they show sequential improvement from 1Q to 2Q? And if so, then stock is going to work higher as we get into the critical kind of back to school shopping and other shopping events in the second half.
Yeah, I love it. Rohit, you asked this on our panel at the Roth conference. You asked a really good question. I'm paraphrasing here, but is Buy with Prime going to stick around? Right? And I think the other two panelists said, no, it'll be gone in a year. And I said, no, you guys are wrong. It's definitely going to be here. And I think I've got some validation from that little sub-paragraph that Andy Jassy threw into his annual shareholders letter. And I'm going to read his comments here for a second. While many brands and merchants successfully sell their products on Amazon's marketplace, there are also a large number of brands and sellers who have launched their own direct-to-consumer websites. One of the challenges for these merchants is driving conversion from views to purchases. We invented Buy with Prime to help with this challenge. If for no other reason this thing's sticking around longer than a year, he put it in his shareholder letter, Rohit. And you had some really smart comments about this earlier on. I'm paying very close attention to this. I do think that this is a foot in the door. They're keeping the door propped open for more to come here. But when you've got $650 billion in revenue out of a $1 trillion market already, if you want to get growth, you got to go where that other 45 is. And that's the .coms, right?
Yep, absolutely. And I think in the most recent earnings conference call, Jassy did explain where when they start to take bets on new growth areas, they want to make sure that if they are successful in that bet, it is a needle moving event. So a needle moving event for a company that is generating so much revenue has to be something very, very substantial. And that needle moving event today, one of the needle moving events right now is something like Buy with Prime. A year from now, if that starts to move the needle, it's a tremendous business. It's already almost like advertising or where advertising was maybe a year or 2 years ago. And we know what happened in the last 2 years with advertising. So they're showing that.
That's a great analogy.
That's how they're putting bets. Yeah.
That's a great analogy. Yeah, I agree. Well, I'll be watching that very closely. And of course, every day we're watching these FBA service commitments like a hawk. So we'll keep talking about that over the next months before our next earnings call together. Okay. One other question. We talk a little bit about Walmart. Is that your beat? Do you watch the Walmart.com business, or is that part of the brick and mortar retail department over at Roth MKM?
As of right now, it's with the brick and mortar retail kind of analysts. So it's less of an important part. It's getting sexier for those people. But as you imagine, at the end of the day, Amazon is the big sexy beast out there. They are the 90% of everything. So yeah, 10% you can keep playing in that small kids table there.
I feel like we need to retitle this episode. Amazon is the big sexy beast. Really, what about Shopify? What are you seeing there? Anything?
Shopify, I feel they are in a tight box. They are trying to be a vertically integrated outsourcer of e-commerce. You are probably a lot closer to it than where I am, but I feel they are. It's a smart tech company, but probably can't morph themselves into a smart tech payments e-commerce logistics company that Amazon is. So the investors look at it from an addressable market, and their addressable market is getting smaller and smaller with kind of the big shadow of Amazon kind of lurking around the various edges where Shopify operates in. And then there are other companies larger companies with commerce kind of aspirations, and they have those assets in some tangential form. Maybe Facebook steps on Shopify, maybe Walmart steps on Shopify stores. And that starts to make me a little bit cautious on what couple of years from now this company could look like.
Interesting. Very interesting. Last question for you, Rohit. I know you're busy, and I'll let you go. This story about Amazon's ownership in Rivian. I know in the previous quarter, some of those losses that Amazon took on their P&L or their balance sheet were really the result of some significant losses in Rivian. Is this something you guys track, and what do you imagine was the impact on this quarter's earnings?
It kind of ebbs and flows. So Rivian is what we call as kind of off-balance sheet investment that the company has done. And by kind of basic accounting, they need to recognize a loss or a gain in that investment at the end of every 90 days. So if the stock price of Rivian goes up, that becomes a gain, and that becomes a part of their kind of non-cash net income. Getting into technicalities here, but from a fundamental standpoint, what matters here is the tight relationship that Rivian has with Amazon probably translates into kind of lesser dollar that Amazon spends to get the product from fulfillment center to your doorstep. That's the final goal. Rivian trucks are going to be less cost intensive when it comes to driving every mile, and if every mile that Rivian truck drives is going to be less of driving by a regular truck. So I think 2, 3, 4 years from now, probably we start seeing in Amazon's results, probably they start passing on those savings to sellers, maybe. But right now, when they show loss or gain in every quarterly statement,
from your mouth to God's ears, I'd love to see them give some relief to the Amazon seller. Yes, please.
You got it right. That's if Amazon, you've worked with Amazon for a number of years, if they do something good, probably they pass on savings or extra service. One of those two things back to their customers. And in this case, sellers would be those customers to benefit. But near term, it's noise for Wall Street right now.
Yeah, totally agree. Rohit, this has been fun. This has been a pleasure. Thank you for coming on and sharing your vast experience and your knowledge in this space. It is always a pleasure to talk to you, and thanks for educating our listeners and our viewers about what happened with this, this fancy thing called Amazon quarterly earnings. I think, I for one would like to have you back every quarter so we can keep tracking this big sexy beast called Amazon. What do you say?
Oh, happy to join again. I've been learning a lot from you, Jason. You've been too kind to host me here, and hope your viewers and listeners enjoy this.
Rohit, tell us how our listeners can get a hold of you if they have some comments about Amazon, or if they're interested in going to market, if they're a mid-sized market company that's looking for some investment. How can they reach you?
Get in touch with Jason. I'm just kidding, but also my email address is pretty simple. My entire last name at roth.com, rkulkarni@roth.com. But again, Jason is my best buddy here. Reach out to him, please.
Thank you, Rohit. I appreciate that. I'll take those calls, everybody. Thanks, Rohit. I appreciate you being here. Thanks for all you do, and thanks for being here. Just to recap, we expected more of a stock price bump given all the relatively good news. As Rohit said, 4 out of 5 stars. If that's a product on Amazon, we'll take it. Wall Street tends to think that AWS is the key to Amazon's cash. But I think Rohit and I kind of unpacked how Marketplace is a real cash cow right there next to it. AWS is important, but look at 3P seller services closely, unpack them to see the real value of Amazon. Amazon's a safe bet, buy if you can. And while the COVID growth has slowed, it is still a big, sexy beast, as Rohit said so eloquently. If you're ready to start growing and protecting your brand on Amazon with a team of experienced Amazon operators, you can visit us at day2podcast.com. That's day2podcast.com. Lastly, if you know anyone else who would gain value from this podcast, please share it with them. Thanks for listening, and happy selling.